It's no secret that the U.S. has serious financial problems. We've been on borrowed time since the 70s oil crisis, Nixon removing the dollar from the gold standard, and the Vietnam War. Add in the fallout from the wars in Iraq and Afghanistan, plus COVID-19, and the picture looks bleak. Let's start with the national debt, $27.4 trillion. Ouch. Add in personal debts, and the U.S. owes $81.9 trillion. These are impossibly large amounts of money. The largest budget items are Medicare and Medicaid, Social Security, and defense. The largest personal items are mortgage debt, auto loans, credit cards, and student loans. This is why the Federal Reserve really has little recourse other than to print more money, and in turn create more inflation. The government's official figures say that inflation is at 1.2%. Shadow Stats, an organization that tracks real statistics behind these government figures, puts inflation at 9 to 10%. This is more realistic to most people's experience with their household budgets and cost of living. Another disparity is that by official figures, unemployment sits at just over 7%. Unofficially, unemployment is thought to be double that. The debts owed by the unemployed will have to be paid, likely by subsidizing debt from their savings or looking for government help. But with fewer people working, fewer tax dollars will be taken by the government right when they need it most. Adding to the woes in the U.S. is an aging population that encompasses major expenses like pensions and retirement payments, medical and social care. An aging population is 10 times as expensive to run as a young one, with a higher rate of illness and many retired. In theory, the elderly have contributed to their retirement funds in advance. In practice, these are invested in cash or risky equities, and their performance has not kept pace with real inflation. The only investment vehicle, up to now, which has kept its value has been gold, and gold within an IRA has performed even better because of the tax breaks on its growth. Yet, the biggest problem facing the U.S. going forward is its currency, the greenback. For years, China and Russia have been trying to dethrone the dollar. China has become even more determined for its own currency to become the global reserve currency of choice, and is well placed to demand a reassessment by the International Monetary Fund. Consider this: the Chinese government has made huge inroads into Africa, so much so that it is China's largest trading partner. Saudi Arabia has built a massive new oil refinery in partnership with China, and marks the first time the dollar has been cut out of a major international trade agreement. The geopolitical tension between Iran and the U.S. has led India to get around sanctions by paying for oil with gold, bypassing the dollar, all with interest from China to pay with its native currency, the renminbi or the yuan. Brazil, Russia, India, China, and South Africa, the BRICS, have all started to use their own currencies to trade within the group. In all of these instances, the dollar becomes irrelevant. With all of this in mind, the United Nations has been looking at the viability of the dollar as the only long-term world reserve currency. Together with the International Monetary Fund, they have been proposing a global currency, which it has called Bancor, and a brand new world central bank to issue it. The effects of cutting the dollar from the heart of world trade would be devastating for the United States, creating a multitude of compounding effects and increasing inflation. The U.S. has become so used to the dollar being used for all international trade, and if this were to stop, the dollar would be subject to a huge sell-off in favor of the renminbi or the Bancor. The U.S. economy has never faced so many challenges, and certainly not all at once. Whether it can recover and regain its former strength remains to be seen.